Good morning, dear students. Today on 3rd of May, we have discussed few more terms which are related with the accounting work. Yesterday we have discussed 5 terms. After those 5 terms, some new terms are there which are discussed today. So here I start with the 6th term, that is the drawings. Actually, drawing or drawings are those amounts which are withdrawn by the owner for personal use from the business. Any value of assets which is used by the owner will also be termed as drawings. Any value of goods which is withdrawn by the owner for personal use taken from the business will also be termed as drawings. So drawings may be the cash, may be the withdrawal of goods, or maybe the withdrawal of assets, or the cost of the use of the any asset will be termed as drawings. Next one is assets. This is one of the most important term which we have to use in accounting. Actually, assets are all those properties of the business which is either cash or convertible into cash, or all those things which the firm possesses or has. The firm may possess some fixed assets like land and building, plant and machinery, motor vehicle, furniture and fixtures, and so on. Those are the assets. Besides this, whatever cash balance or bank balance the firm has, that is also the asset, or any amount which is recoverable from the outsiders which is to be received will also be termed as assets. So debtors means those people who are outsiders and they have to give the money to us, they are also termed as assets. Next one was capital receipt and revenue receipt. Receipt, first we will have to understand. Receipts are those figures, those amounts which are actually received in cash. There may be two types of receipts: capital receipts and revenue receipts. Capital receipts are those non-frequent receipts of cash amounts which we receive once a while. For example, if the firm has taken the bank loan, this is a capital receipt. For example, if the capital is invested by the owner into the business, for the business it is a capital receipt. Or sale of any fixed asset, the amount which is received is the capital receipt. Revenue receipts. Revenue receipts are those receipts which are frequent receipts of amounts. Any amount which is frequently received by us is a revenue receipt. For example, sale of goods. Whatever amount is received, that is a revenue receipt. Next one is expenditure. Expenditures are those payments which we pay to the outsiders. Expenditures are those expenses which are incurred and firm has to bear the cost of it. These expenditures are also of 3 types: capital expenditure, revenue expenditure, and deferred revenue expenditure. Capital expenditures are those expenditures when we purchase the fixed assets, that is a capital expenditure. Revenue expenditures are those expenditures which are paid in frequent form, like payment of salary. Deferred revenue expenditures are those expenditures which are of revenue nature, but the benefit of it is derived or got over the next few years period of time. So those expenditures are treated or said as deferred revenue expenditure. So remember, in deferred revenue expenditure, they are by nature revenue, but the benefit is derived or benefit is got over the next more years period of time. They are the deferred revenue expenditures.